Alright, so on we go. Screencast number 4, how banks create money. And here things are getting even more technical, so put your really smart brain in for this one. Alright, so last time we explored what was called the money market graph. And again, the idea here is that the demand for money is the demand that we have collectively for money for all reasons. That supply of money, that vertical supply curve, is determined by the Federal Reserve. They get to decide where that supply curve is, and by deciding where that supply curve is, they can therefore decide what the interest rates are going to be in the economy. As you can picture it, moving that supply curve to the left would make interest rates go up. Moving it to the right would make interest rates go down. So what this screencast is about is exactly how the Federal Reserve moves that supply curve, and it's so complicated that I despair even beginning to explain it. Nevertheless, it's important for the AP exam and important to understand how monetary policy works, so we're going to do it. And it involves banks. And what we're going to see is that it's through banks that the Federal Reserve moves that money supply curve around. It's a kind of circuitous, very indirect process. So here we're going to talk about how banks create money, and by creating money, therefore moving that money supply curve. And it's a long story that goes all the way back to these people called goldsmiths in the Middle Ages. And that's really how banks started. They started just as places that you could store your gold, and those places would keep all of your gold in the bank. Well, that changed over time, and in class we'll be talking about what that story is, until what we have today, which is called the fractional reserve banking system. Which means that when you go down to the bank and deposit $100 there, they don't keep all $100 in their vault. They only keep a certain fraction of that in their vault, and the rest of it they can do things with, like lend out. And it's the lending activity that by banks that actually creates money in the economy, as we're going to see. All right, so to understand how this actually happens, you're going to need to learn a little bit of accounting. And for this, I apologize. Now, my brother was an accountant before he was president of all things Tic Tac, so I know how dreary the world of accounting can be. And if any of your parents are accountants, I apologize in advance. But we're going to need to learn a little bit of accounting to understand how this whole process works. So I'm going to introduce to you something called a balance sheet, and specifically a T account. This is a accounting procedure by which banks keep track of what they have and what they owe to other people, and it's commonly used by other institutions as well. We're going to divide the T account into two sides. On one side, we're going to label it assets, and I want you to think of that as things that the bank owns. On the other side, we're going to have what are called liabilities and net worth. And this side is going to represent what the bank owes to other people, whether to its depositors, which we'll call liabilities, or what it owes to the owners of the bank, which we'll call net worth. And the idea behind a balance sheet is that the two sides have to always equal. Assets have to equal liabilities plus net worth. And again, we'll see this going forward. All right, so here's what a typical T account looks like, a typical kind of balance sheet. On the left side, we have assets, what a bank owns, and on the right side, we have liabilities and net worth, what a bank owes to other people. And again, both sides always have to be equal. That's important going forward. So let's start by creating a bank and work through a typical transaction. Let's say investors raise $100,000 to form a new bank called Sloth Bank. What happens is investors grab $100,000 and give it to the bank, and in exchange, what the investors get is a stock certificate that says essentially you own 100% of this bank. Let's see what that would look like on the balance sheet. On the left-hand side, what the bank now has is $100,000. That's now the bank's money. On the right-hand side, the bank now owes $100,000 worth of bank to the investors. The investors have a piece of paper that says they own this bank, and what the bank has currently is $100,000. We call that net worth, sometimes called capital stock. All right, so now the bank wants to open for business, and it's going to need some property and equipment. So it takes its $100,000 and it goes out and it buys office space, furniture, ATMs, etc. Essentially, it's taking that $100,000 and simply turning it into property. So now the balance sheet might look like this. No more cash, but now the bank owns $100,000 worth of property. Notice that the two sides still equal. All right, so now the bank's open for business, and let's say Susie takes $50,000 out from under her mattress and opens up a checking account at Sloth Bank. Let's see what that would look like in the balance sheet. On the left-hand side, the bank now has Susie's $50,000. That's now actually the bank's $50,000, and it's sitting in the vault of the bank. Susie has given up her $50,000, and what she's gotten in exchange for it is a checking account, basically a number in a computer, $50,000 that she can write checks against. Now, a couple of points here. On the right-hand side, you'll notice I'm calling those checkable deposits. You might also see those called demand deposits. I want you to think of that as simply money in people's checking accounts. Another little note, on the left-hand side, we have that $50,000 in the vault now. That vault cash isn't part of the money supply. It's not part of M1. M1 is money in circulation, and this money is now out of circulation. So you'll notice that the money supply hasn't changed, right? Because the money supply includes cash, coins, checkable deposits. And so here we have $50,000 more in checkable deposits. That's $50,000 more M1. But we have $50,000 less M1 because that money, that cash, was taken out of the system. So our M1 money supply hasn't changed at this point. All right, now here's where it gets technical. Banks are subject to what's called a reserve ratio, or a reserve ratio requirement, and that's set by the Federal Reserve. It's simply a percentage of people's money that the bank has to keep in one of two places. It can keep it in its own vault, or it can drive it down to the Federal Reserve Bank and keep it in the vault at the Federal Reserve. Now that reserve ratio, again, is a percentage. So what we're going to do now is take that vault cash of $50,000 and divide it into a couple of different categories. Actual reserves are the cash that the bank actually has in the vault or at the Federal Reserve, and in this case, that's $50,000. Think of that simply as the money in the vault. Required reserves are what the bank has to keep in the vault or at the Federal Reserve, and again, that's set by the Fed. So the formula for the required reserves is the amount of deposits times that reserve ratio. Here we have $50,000 worth of deposits. Let's assume the reserve ratio is 10%. What that means is that the bank has to keep $5,000 either in the vault or at the Federal Reserve. And this is one of the ways that the Federal Reserve controls how much money banks keep in their vaults. Excess reserves, then, would be actual reserves minus required reserves. Excess reserves is the difference between the money that they have in the vault and the money that they actually have to keep in the vault. Well, if they have $50,000 in the vault and they have to keep $5,000 there, they would then have $45,000 worth of excess reserves. So we can divide that cash into two categories. What's required to be there, $5,000. What's extra, $45,000. Now those excess reserves are really important because the bank doesn't have to keep that money in the vault. It could do other things with it. And one of the things that banks tend to do with their extra money is to loan it out. This is the fractional reserve banking system, the idea that the bank doesn't have to keep all of your money in the vault. All right, so now the bank has $45,000 that it could do whatever it wants with, including lend out. So let's get to the interesting part. Transaction number 4. Let's say that some guy named John decides to come to the bank to borrow $10,000 because he wants to buy a car. Now this is the weird part and takes a little thinking about, but this is the mechanism through which the Federal Reserve can create money through banks. What happens is that John writes out a little IOU, I owe Sloth Bank $10,000. That IOU isn't money, it's a piece of paper, right? We haven't defined M1 money as IOUs. So the bank takes that IOU, they call it a loan, and they stick it in the vault with the rest of the stuff. And in exchange for that, what they do is open up a checking account for John and deposit $10,000 in that checking account. How do they do that? They walk over to a computer, they type in the word John, $10,000. In essence, John is exchanging something that's not money for something that is money, because money in checking accounts is money, according to how we've defined it. You remember that M1 money consists of cash, coins, traveler's checks, and money in people's checking accounts. Now you might have missed it, so I'll backtrack a little bit. But when the bank made the loan, and this is the big important part, it actually created $10,000. Let me go back a little bit. Here's what the situation looked like before John takes out the loan. Watch the checkable deposit number. He hands them the IOU. They add in electronically through a computer $10,000 into a checking account for him. And now we have $60,000 in checkable deposits, whereas before we only had $50,000. The bank just magically, out of thin air, as strange as it sounds, created $10,000. Now that's going to have an effect in terms of our money market graph. Here's what the money market graph looked like, and there's that supply of money. What's going to happen now is that the supply of money is going to shift to the right by $10,000. There's 10,000 more dollars out there in the economy. And as that money supply moves to the right, it's going to change interest rates. Interest rates are going to start dropping. Just a little bit, but they're going to start dropping. Now, the converse of that means that when loans get repaid, money gets destroyed. And to keep things simple, let's say that John immediately just has second thoughts and turns around and decides he doesn't want this loan. He wants to call the whole deal off. So what he does is take out $10,000 from his checking account and sends it to the bank. The bank takes that IOU, rips it up. John doesn't owe that money anymore. And again, focus on what happened to checkable deposits. Here's what it looked like before John rips up that, John pays it back. And here's what it looks like afterwards. Again, the two sides are balancing. We have $10,000 less in checkable deposits, $10,000 less in loans. More importantly, when those loans got repaid, that $10,000 just vaporized, got destroyed, just totally went away. So the big idea here is that when banks make loans, they actually create money and move that money supply curve to the right. And when loans get repaid, money gets destroyed and that money supply curve can move to the left. Now we're going to work through this in class because it's relatively complicated and you'll have a couple of stabs at understanding this. But the main idea is that when banks create loans or make loans, they create money. Now, a final note, banks pursue two conflicting goals. On the one hand, they want to make as much profit as possible, so they want to make as many loans as possible. On the other hand, they have to stay liquid. They have to have a certain amount of cash in their vaults so that when people ask for their money, they actually have that money. Well, sometimes they make too many loans, and sometimes they're not actually meeting their reserve requirement. The Fed can control how many loans are created by changing how much excess reserves the bank has by changing that reserve requirement. In other words, if the reserve requirement was 100%, there would be no excess reserves, and banks wouldn't be able to make any loans or create any money. When banks find that they're short on required reserves, that they've made too many loans or too many people showed up for their money, one way they cover the difference is by borrowing some money from other banks on a short-term basis. When they do that, they pay those banks an interest rate, and that interest rate has a name. It's called the federal funds rate. That interest rate's important because it's the interest rate that the Federal Reserve focuses on when it undertakes monetary policy. We'll see more about that in the future, but I wanted to mention it now because that federal funds rate turns out to be relatively important. All right, again, relatively complicated, but stick with it. We're a little more than halfway through the unit now.
Damn it, this is too hard! Here's what I think of your test, Mr. Teacher!